some of them have been
I
around,
use them
like
never active.
That's
the
good. Giving
bigger
you
name
ideas.
firms for a
If I
lot of
get you in the
years.
weeds, pull me out.
Right, okay, I'll
For the
I'll
folks in
I'll
the
give
back,
them-
there's actually plenty of empty chairs up front. So if folks want to move up, there's plenty of seats. The next panel is about a topic which is actually pertinent to pretty much every restructuring that I've been involved with, but is not really covered in much detail, which is how to maximize the value of deferred tax assets. I'll turn it over to Geoff Bailey from PORTENO Capital to introduce the panel. Thanks.
Good morning. Everybody hear me okay? Wonderful. Okay, the topic of this panel is deferred tax assets, what they are, their economic value, and how investors in distressed situations can enhance their returns using deferred tax assets. My name is Geoff Bailey, and I'm your panel moderator. I'm going to introduce our panel members. First, on our far left, is Sara Zablotney. Sara is a nationally recognized tax partner at KIRKLAND and ELLIS. Sara is involved in some of the decade's most prominent transactions involving both corporate buyers and private equity. This includes AbbVie's $63 billion purchase of Allergan and Apex purchase of Metametrics for $4.4 billion. Sara counsels distressed and restructuring companies, including Energy Future Holdings and more recently Full Beauty Holdings. Second, we have Ken Grossman. Ken's an accomplished attorney, investor, and board member specializing in distressed situations. Ken was a director of Lehman Brothers Special Finance and served as a director and president of Signature Group Holdings, which was the corporate successor to Fremont General Corporation, one of the largest pre-2008 subprime mortgage originators. And third to my immediate left is Timothy Brog. Tim was a lawyer at Skadden Arps for 6 years, an investment banker at Edward Andrews Group for 10 years, portfolio manager at activist hedge funds Pembridge Capital and Locksmith Capital. Tim has served on many boards of directors and been a CEO. As CEO of Peerless Systems, Timothy tripled investors' money in 4 years, and he's currently chairman and CEO of RUBICON Technologies, a publicly traded corporation, and the stock price has almost doubled in 2.5 years. So this panel is going to focus on explaining and defining deferred tax assets, how they arise, the basic tax rules and basic accounting rules. Next, we're going to discuss the value of deferred tax assets from the perspective of all the different professions represented, from a CEO, an investor, and a tax attorney. Third, we're going to explore how value is realized from deferred tax assets. We'll talk about how investors can incorporate DTAs into their calculation of intrinsic value. And then last, we'll get into some real-world example and some anecdotes. So first, we're going to start broadly and just define and explain deferred tax assets. And so let's all ask all of our panel members, Sara, how do deferred tax assets originate from your perspective as counsel?
Well, usually from nothing good. So the tax lawyers are all super happy, but the deferred tax assets we're talking about here are the kinds of assets that are realized from losses. So net operating loss carryforwards, capital loss carryforwards, built-in losses, and there's a new category of deferred interest expense, so the 163J tax assets. So these are all types of things that go from outflows from the company that are deductible. We're not generally talking about deferred tax assets that are just timing tax assets, that are GAAP tax assets. We're talking about things that lead to immediate reduction in cash tax liability potentially in the future to a distressed company.
Ken?
Thank you. As an investor and portfolio manager, which is the way I've approached these situations in the past, we're usually looking at historic both operating and financial losses. And I think operating losses is self-evident. By financial losses, I would refer to losses that arise from the payment of interest, usually in private equity type deals that are somewhat seasoned, and companies fail either from a balance sheet perspective or a balance sheet and operating perspective, and have incurred losses that lead to a bankruptcy, which is generally where I get involved. Just for sort of order of magnitude, the larger the loss, the greater the interest among sort of the hedge fund community or the subset of the hedge fund community that will gravitate toward the situation. Companies that file with sort of sub $150 million losses don't garner a lot of interest. If it's approaching 600 million or more, you tend to get a lot of people attracted to the situations.
I usually step in once the losses are created, and the only thing I would add to Sara and Ken's list of deferred tax assets are, and I'm not sure if they qualify as deferred tax assets, but lots of times you have R&D companies or biotech companies where there's a lot of research credits, both on the state and the federal level, that are useful in trying to monetize something of value.
Yeah, and the only thing I would say with the R&D credits is that my experience is they attract a lot of scrutiny and diligence, because the process for proving those out can be difficult, and they are an area that the IRS and the states look at to try to validate, so they do get a lot of scrutiny, and so you have to think about whether they're dollar for dollar or whether you should apply a discount to them, and thinking about the number that's reported.
So Tim's comment just reminded me of a third source, if you will, of the losses that can be available in a distressed or bankrupt company, and that occurs where there's been equity raised for, and I think biotech and technology, digital and electrical technology are the two big areas, although there are others. I've seen it in materials technology as well, where for whatever reason the phase 3 fails in the biotech area, or a better mousetrap comes around for the software or the other disruptor, and all of a sudden you found that there's been $400-600 million in multiple rounds of equity that have been raised, and that can actually often be the most interesting of the prototypes that people will seek to invest in or fund going forward.
Yeah,
Because there's no debt, and I'll leave it over to Sara because she's probably the expert. I think I know what you're going to say.
Yeah.
There's no cancellation of debt income, right?
Right. No, that's right, and that can be really interesting. It can also be interesting in the private equity context, because private equity usually establishes multiple chains, so you'll have, or multiple tiers in the chain. So there'll be several companies in the chain with high tax basis, not all of which are debtors, some of which are outside the credit net. And that has proved very useful in some restructurings recently, when we've been thinking about exits, because there's a nice built-in loss that's sitting there as a result of the equity capital that the sponsor put in.
The one thing I would add, more from an investor perspective, is because of the uncertainty that Sara referred to with regards to the review by both the federal and the state governments into research type credits, is that the accountants, rightfully so, will require you to put on your balance sheet a contingent liability. I think it's a FIN 48, or at least
Correct.
it used to be a FIN 48. And so when you, I know with Peerless Systems, because we had utilized some R&D credits, that we had a large number on our balance sheet that looked like debt or a potential liability, but as time went by, and after the third anniversary of the date you filed your tax returns, and then I think maybe fourth anniversary in California, they rolled off. And a lot of very sophisticated investors just assumed that was a real liability as opposed to a contingent liability. And there's that's
Yeah,
just
I'll-
something that's hidden that sometimes people could notice.
I'll disclaim gap expertise, but from my layman's perspective, FIN 48 means that you don't have a more likely than not or greater confidence in the result that you're getting. And so the accountants then make you take a risk-adjusted reserve against the asset based on how you and they think that it will actually come out when you negotiate with the taxing authority.
So all three of you are tax experts. Do you find that your perception of the importance of the tax assets is always recognized, or are there occasions where you have to fight for influence within the boardroom or during corporate decisions? Sarah?
You know, in the distress scenario, I think most sophisticated, distressed folks, professionals, are pretty savvy to the value that a tax asset can bring. There's enough case law out there, like the Prudential Lines case, that tells you that, you know, this asset is an asset of the estate in a bankruptcy. So people are focused on that. Where I get more pushback and where I have to coordinate more is really just in regular way pubco. So private equity investors are all over it because cash is king and they care about cash taxes. But when I'm talking to a public company board, it's not necessarily the cash tax, it's how does this affect my effective tax rate? How does this impact earnings? And so that's the discussion I have to have rather than you have this amazing asset. It's, well, this is how you should think about it rolling through your financial statements over the next several years.
So I'm going to take a slightly different perspective, but really focused on the distressed company. So needless to say, when you have companies in trouble, heading toward bankruptcy, losing customers, losing employees, being disintermediated and disrupted in terms of their basic business model, the fact is that preserving tax losses, and I think it's my experience is actually at this point more than anecdotal, is way down the priority list for management and sometimes even highly sophisticated advisors, because there's just so many problems that the management and the advisors can deal with. And one of the exercises that I've had my partners undertake in recent years is to try to be ahead of the curve for companies that are going into Chapter 11, where you can really take advantage of this, which we'll get into later, and do the planning that's necessary to preserve the NOL and maximize it as part of the restructuring, part of the sale of assets, because there are decisions that are made along the way that affect the preservation and the usefulness of these long-established loss carry forwards. The flip side of it is that sometimes they've been, and again, Sara and I discussed this before we came, I'm going to use the word torched. It's not a word that's in the Internal Revenue Code or the Bankruptcy Code, but if there's been sufficient pre-bankruptcy ownership shift among the shareholders, there's a decent chance that the NOLs have been either eliminated or severely limited. And you wouldn't wait. If you can arrive at that conclusion early enough in the process, you won't waste your time, even though you think there's many hundreds of millions of dollars of losses that reside at the taxpayer. So it goes both ways. I would just tell you that my experience is that if you're looking at a distressed company and it's sizable, certainly it's important for the investor base to look early and to look granularly at the historic losses that are going to be there when the bankruptcy occurs.
Ken, I don't disagree with that, but I would say that because the use of tax losses is really just a trade for no tax now versus tax later, it's part of the liability management discussion as you head towards a bankruptcy. And I think people do understand that, especially if it's presented to them that, okay, you can do this liability management transaction now, you won't pay tax, but that means maybe in 6 months, 9 months, a year, 18 months, you will have a cash tax based on the model. And so you need to think of that because, one of the liabilities, and it's going to be a priority liability, is the tax liability. So you have to keep that in mind when you're playing out how to use and maximize the use of the NOL.
Well, you don't want you don't want the tail to wag the dog, on the one hand, and on the other hand, the NOL is an asset of the company, no different than some of the other assets of the company. So I think that it's important for the board to recognize that it is an asset like every other asset, and that it needs to be protected to prevent some kind of impairment or the inability to use it. But again, they're thinking in terms more of coming out of bankruptcy, and I view it more of just a distressed company that hasn't hit the bankruptcy yet, but has the NOLs.
And so, Tim, do you have difficulty getting that across to your fellow board members sometimes? The value of the deferred tax assets?
Well, you'd be surprised because there are a lot of public companies out there in the world that have NOLs, but have not taken the necessary steps to protect them. And because the boards are usually ignorant to whether or how to protect them. One of the best ways to protect them is to adopt a shareholders' rights plan, otherwise known as a poison pill, so that you never get to a point where there are any new 5% shareholders, and therefore making sure that you keep the NOLs. So most board members know nothing about it. Even in companies that, I've dealt with companies that had over $2 billion worth of NOLs, but they didn't do anything to protect it. And they all, one of the common refrains when you call them out on it is that, oh, well, when we got close, we'll do something about it. But it's pretty easy to go over, to create a change of control, and a lot quicker than they can react to it. So.
Yeah, I think that's right. We've put in place pills for several companies over the years. I think they can be good. They can be a great tool. I think your M&A colleagues like them a lot for lots of reasons, frankly. And for that reason, the investor services do look at them. I think they see the difference between an NOL poison pill and a regular poison pill, but it is a discussion, and I think that is also one of the deterrents to a board adopting one.
Yeah, I sorry, I didn't mean to interrupt you.
Okay.
But I actually got a call from ISS. I don't know if that's who you're referring
exactly.
to. I got a call from ISS about we had adopted a pill, and even for not a 10 or 15% pill, but an NOL pill, they still want shareholders to approve it.
Correct.
And I'm a big proponent of ISS, and I agree with 95% of what they say. I'm not so sure that giving the shareholders the choice to not approve the pill for an NOL pill only is the smartest thing in the world. But
Right, so it might be a little beyond the scope of this conference, but because we're mentioning ISS, we sort of move into the terrain of the activists and people like Starbird and Elliott Management, which I understand is probably speaking here later today. So take the situation where there is, hundreds of millions, if not $1 billion of losses in a public technology company that turns the corner and may not be anywhere near profitable enough to utilize the NOLs, but, and I've actually had meetings with some of the very large activists on this subject over the years, where the NOL pill, which limits the holdings, I think, Sarah, isn't it usually 4.5%, or do they go to 4.9?
Depends.
It's somewhere between 4 and 5%. because it's only 5% holders that count for purposes of ownership shift analysis under Section 382 of the tax code. And so the activist is then stymied from going above that amount unless they get permission from the management, which is unlikely at this point, if they disagree with the strategy. So it's sort of the classic event that happens in the investment banks and the large advisory law firms, which is that the law of unintended consequences kicks in, and an activist who might have something constructive to actually say is limited in how much they can buy by virtue of the pill when there's been a change of fortune of the target.
But let me just add one thing. Usually, I mean, I was an activist for 6 years or so. So, but I just lost my train of thought. Okay, go ahead.
Oh, okay. Well, but before we go any farther, we've touched on this tangentially, but Tim, your firm Rubicon just put in place the poison pill, like you said. Can you fill in the gaps as far as why your firm did that, what legal steps you had to take, and what response you've received so far? So you addressed a lot of those issues, but if you could just kind of fill it out for us.
Well, I mean, the one thing I just remembered what I was about to say is that I think the board, lots of times shareholders who are activists will request a waiver of the pill, and to the extent that giving them the waiver doesn't impact the NOLs, I think a board has a duty to give them that waiver, because the whole idea behind the pill is not to prevent them from buying more shares, it's to prevent them from impairing the NOLs. So I think, and there are cases where activists will write a letter saying, you're nowhere near the 50% change of control. Can I increase my stake from 4.9% to 9.9%? And I think there's a lot of case law out there that says that the board cannot hide behind the pill to keep an activist away, and especially when there's lots of headroom under 382. So we adopted a pill. I mean, I spent most of my career, ranting and raving about how bad pills are for shareholders. But there are limited situations where they do make sense. And, you don't know if a board is going to be shareholder friendly and really adopt the pill because they're worried about the impairment of the NOLs, or whether they're really doing it for more entrenchment type purposes. So I think my reputation gives some people comfort that we're not doing it to entrench ourselves, but to really protect the NOLs. And so I think it was an easy sell within the board, but we have received a lot of requests to waive the pill, but the thing is, we've received a request from many different people, and I don't know how we could grant it to one group and not to every group. So that's one of the issues that we're dealing with.
And so would one of our panel members explain why the poison pill is important in relation to Section 382?
Yeah, I think that probably goes to me. So, look, what Congress didn't want people to do was traffic in net operating losses. They didn't want scenarios where people basically were selling boxes with losses and sheltering profitable businesses. So there was a specific abuse. There were several code sections, including one that everybody talks about but isn't enforced, called 269. And it wasn't working, and so Congress took a sledgehammer to kill the fly that was the problem of this loss trafficking, and we ended up with the current 382 limitation. And what that says is, if a corporation has a change of control, the use of its net operating losses and if it's in a net unrealized built-in loss, its built-in loss going forward after the ownership change is limited, and the limitation is pretty draconian. It's the equity value of the company, which in the case of a distressed company is going to be quite low, times the long-term tax exempt rate, which is a rate that's published by the IRS every month, and it has been hovering at less than 2% for about a decade. So basically, your base limitation in a distressed scenario after an ownership change is 0. It's not that useful. There are some exceptions for realizations of built-in gains in the 5 years after the ownership change. So they're trying to keep you neutral to as if you had sold the assets prior to the change in control. Those exceptions are proposed to be limited even further by regulations that were recently published. We'll see what happens. There are some special rules for bankrupt companies. So if your change of control happens as a result of a Chapter 11 plan, you can access one of 2 favorable rules. One of the favorable rules, which you'll hear people talking about, the L6 exception, that's the one I see most. That one says, okay, we understand that you don't have equity value. You basically get an add back, so that you basically get to count your new equity value. That's kind of the way to think about it. So you get a much more favorable limitation. The other rule, 382L5, you basically get to keep your NOLs subject to a haircut. But if you have another ownership change within 2 years, the whole thing goes poof, and your NOL disappears forever. So if you're trying to access that exception and you can meet its stringent requirements, which given there's some holding period for debt rules that are really hard to meet, but if you do it, you see people put in place actual charter restrictions. So forget about pills. There will be charter trading restrictions so that there is not an accidental change of control in that period that blows up the NOL.
So just to follow up on 2 points that Sara made, in addition to the charter restriction at the beginning of most large public bankruptcies, almost in the same set of what they call first day motions in a bankruptcy for utilities and opening of bank accounts and hiring ordinary course professionals that the company deals with, is a motion to the court for a trading restriction, which says that because in a lot of these companies, especially ones where it comes as a surprise, all of a sudden you have a stock down, it opens up on the announcement of the bankruptcy, down 100% or 98% or something like that, and speculators come in and all of a sudden somebody owns 9% or 12% or 22% of a public company unwittingly and perhaps pushes the company close to the ownership shift at 50% and again, using the vernacular, not the technical term, messes up the NOL. So you have that additional weapon or tool, I guess is a more appropriate word, that can be used in the context of bankruptcy filing to protect the loss carry forward. And I will share one anecdote where it actually worked to the detriment of the estate and even the unsecured creditors, because there was and it was linked to what I said before. There was a biotech company where there was a very small fund that was in the same space and owned some assets and some technology in the same space that bought up to 4.9% right as the bankruptcy occurred, made an application to the debtor to go higher, and actually had a plan, we found out later, to get to 20 or 25% and refinance the company. But the debtor's trading order gave them 30 days to respond to the request. They took the full 30 days, and then they said no. There was really no reason for them to say no. It was probably not a good faith denial in my view, which is probably why I'm not mentioning the name of the company. But if that fund had been able to acquire, let's just say 20% of the company, they had a plan to do a refinancing where they were essentially going to pay themselves back or make a profit on their own stock, but they needed to own at least 20, 25% to get there. And the stock was very liquid. It traded millions of shares a day. There was a very, very large contingent of people who liked the company and thought it was technology, and because there was a secured creditor, and the unsecured creditors were very small, the secured creditor demanded that they enter into a very short 363 sale process, and that's what happened. And there were no other bidders. There's an alternate plan that would have created more value. That was, I think, stymied by what I'd call the successor to the pill, which is the trading order in the case. I'm not against them. I think they serve a purpose, but I think that they can be overkill or abused.
Yeah, and I think it's actually, one thing I want to backfill is why 5% is important. The rules are not super logical. It's not a one-time 50% change of control. The rules count changes among 5% shareholders, which is itself a term of art and aggregates certain kinds of people over a rolling 3-year period. And so it can take the accountants, if people haven't been tracking that, it can take the accountants some time to figure it out. You can rely on public filings if it's a public company. So the Forms 13, you can rely on them, but it is something that you have to actually sit and track. And when you're relying on forms, if it's a historic shareholder that's just gone up a little bit, you may or may not get a filing until the next February. So it's an interesting and tricky area.
And it's not, the calculation of that change of control is not very intuitive.
Nope.
So if I'm a 7% shareholder and I sell my shares, and a week later someone shows up and they own 6%, and it's pretty certain that it's, you sold your shares to that person, they count that, sometimes they count that twice, both the loss of my 7% plus the gain of the 6%. So you have a 13% control, unless you can prove, this is my understanding, unless you can prove that it was a direct sale and that those shares actually came from.
Yeah, they've improved those rules recently, but yes, you have, there are circumstances where you can get to a bad result.
Ken, you mentioned trading orders. Would you elaborate on what they are and your opinion of them?
Sure. So I think I gave a little bit of background a moment ago about the trading order. The order, in summary, says that in addition to the trading aspect, there you're prevented from taking a worthless stock deduction initially, and then secondly, which is kind of crazy in a way because the stock in most of these bankruptcies is worthless, but you are prevented from taking it. And then secondly, the order says that if you go above 4.5%, the trades above that amount are, per the bankruptcy court, and this is a legal term of art, void ab initio. It's as if the trade never happened, in order to preserve in order to keep that new holder below 5%. How mechanically one unwinds that, I'm not sure. I just remembered I was involved in a situation where a London-based hedge fund inadvertently went to like 40% of the company. When I say inadvertently, because they had no idea there was a trading order. And there was a lot of sort of nasty letter writing and emails back and forth between the debtor corporation and these fellas, and they took a big loss, and they actually sold the shares in the marketplace over a period of time, and it's pretty onerous if you're not aware of it. I would say sort of 98% or even 99% of the investing community is aware of trading orders in bankruptcy, but it would not surprise me to have either retail investors or someone who specializes in industry show up and say, wow, that company is worth a lot of money, I know the technology, I'm going to buy the stock, and then someone tells them they have to file a 13D, and next thing you know, they violate it, and there's a big dust-up in the bankruptcy court over the situation. So as I said, the trading order is important because it allows the debtor to control who goes over 5%. And I think, as my colleagues mentioned before, the analysis is, to use your term, is not intuitive, all right? And the company often doesn't have sort of the current analysis on its table as to who owns how much going into bankruptcy, or really they know who owns how much, they don't know who's sold. And so they don't know how many 5% shifts of ownership they've had. So it can get, so the trading order serves a purpose in just keeping everything stable for the moment, but it can have unintended negative consequences.
You would be really surprised how many people swallow the pill, blow the pill, or whatever you want to call it. And there's just been situations where people have called me up and said, we just bought 5.2% of your company, and I would say to them, but you do realize we have a 5% pill in place, and there's a long pause in the conversation. They say, oh, we'll get back to you. And the same day they sell down, and I guess they feel that since they closed the day out at below the 5%, they don't file a 13D. But it happens pretty frequently.
Sara, would you elaborate on another perspective of trading orders as somebody who counsels corporate clients?
Yeah, I mean, I think if I am counseling a big, particularly public investor, and then also I think in the private equity context, because worthless stock deductions can cause a change of control, it's not intuitive, they can. I think, at least from my perspective as an advisor, it's very important for me to advise the company to put this in place. And I think it would probably be malpractice if I didn't. The NOL and the tax attributes give the company optionality in restructuring. So, part of what I'm trying to preserve is the ability for the company to maximize value for its stakeholders when we're exiting, and part of that is having the flexibility either to emerge without paying cash taxes for a while in the model, or to be able to do some interesting transactions that don't strand a tax or give a priority to the service vis-a-vis an asset sale or some other transaction. So, I think putting it into place is crucial. I think the important thing to counsel the company is to address Ken's point. Look, when people come inbound with ideas, part of your fiduciary duty as the board in a distress scenario is to listen to these ideas and think about what is stakeholder maximizing in this scenario.
So, Tim, you have in Rubicon Technologies, there's a significant deferred tax asset balance, and there's an accounting rule that essentially is a valuation allowance, and according to GAAP, if a company hasn't produced an operating profit for the last 3 years, then the deferred tax asset can't be recognized on the face of the balance sheet. So if an investor calls you up and says your deferred tax assets aren't worth anything because they're covered by this valuation allowance, how would you respond to that?
Well, NOLs were worth a lot more before this most recent new tax laws came into effect. People ask me all the time, what are your NOLs worth? And I usually tell them, between 0 and 20% of what our NOLs are. Taking advantage of NOLs are people think they're relatively easy to do, but it's not, because you have to worry about the 382 change on the one hand, so and you need to have enough cash on your balance sheet to buy something or do something to generate the income to then to use your NOLs. And if you have big NOLs and no cash, well, it's very hard to to buy something or do something. You can't just issue stock, because then you have the change of control. So so the answer to your question is it's worth something, but probably a lot less than some investors think, but it's worth more than 0.
I would just point out that before the recent tax law change, most investors on their, analyses peg the NOLs somewhere between, let's just say, 8 and 12 cents on the dollar. It's within the midpoint of what Tim mentioned. I would say as a result, not only of the tax law change where the rates are lower, so it makes sense that the value of the loss carry forward, the shelter from the last loss carry forward would be less, has diminished those estimates. And then the second piece of it is that there have been more NOL companies emerge and, as Tim pointed out, really been unable to exploit the capital structure they have over the last probably 10 years, and maybe even longer. So in some sense, I think the bloom is off the rose for these companies, which is why earlier I emphasized that size is important for investors seeking an opportunity in those assets.
Anybody in the audience have any questions for our panel members?
So if there's a change in with the election coming up and tax rates go up, what's going to change with the deferred tax assets, you think?
Well, I think if corporate rates go up, there will be renewed interest in these entities. And one of the items that was mentioned, although I'm not sure it was emphasized, is the 3-year rolling period for ownership shifts among shareholders, so that by the time there's an election, new administration, corporate rates go up again. Let's just say it's 2 years from now. Anyone who bought stock, who owned stock a year ago, even if they bought 12% of a company, am I right, Sarah? It won't count, right? Because it'll be 3 years.
Right,
On
but
the
the
third
person-
anniversary, it doesn't count anymore.
Unless someone else has come in the meantime.
Right,
'Cause
but
it's rolling,
that person doesn't count.
Right. I would agree with you, but you still have to have income. And
Right.
I would also say that I would guess that whatever new administration comes in will not change the negative changes to the use of NOLs. So used to be that you functionally could use NOLs against 90% of your income. It's now 80%. And so old and cold NOLs are great pre-2017, although they expire after 20 years, those are 100%. But the new ones, you've got this 80% limitation, and so it won't fully shelter cash taxes. So it's not quite as good as you might think it is, and I'm guessing a new administration wouldn't change that, so that would temper my enthusiasm.
Yeah, but there's 20 years is a really long time.
Oh, yeah.
And there are a lot of companies out there that have these NOLs.
Yep, and they're fabulous.
So I think there's a lot of opportunity out there.
Well, so Tim, what do you see as far as the future of your firm as an operating company with a large deferred tax asset on your balance sheet if tax rates go up, corporate tax rates go up?
Well, we're a small public company. We have $180 million or approximately $180 million of NOLs. So we fall below Ken's threshold of $600 million or whatever it is. But look, if we can find a transaction that can generate cash, I think there's whether the tax rate's at 20% or 30%, I think there's a lot of value there. The key is most acquisitions don't work out. Probably around 80 to 90% of them don't work out. The seller's not thinking, wow, we're at the bottom of the market, I want to sell now. Usually there's not a symmetrical amount of information between the buyer and the seller. So it's a very difficult way to generate a profit if it's solely through non-organic acquisitions. But I think that if you do it right, there's some value there.
Any final quick questions from the audience? Okay, thank you very much.